is GE up 9% right now?
Well, it all depends on where you start from. And let's just start with Mr. Markopolos' report. There's a kernel of very good analysis in here. His work on the long-term care liability is very good work. But there's a lot of hyperbole and innuendo around it. So why is it up 9%? Well, it's just math. I mean, first got slammed significantly with the release of his report. Now it's bouncing back because as we really start to digest it, we can look and see, okay, what here is new and what here is rehash. And no small part of this is rehash.
And to that point, Brian, what is your assessment of both that report from Markopolos and also the company's response?
Good. So first of all, in terms of the report, and I won't tell you I've memorized all 170 pages, but the core analysis he's done on the insurance side is very good work. The broader theme of the report and the innuendo, there's a lot of garbage in it. And with respect to the company response, let's be realistic. If you say something bad about my mother, I'm probably going to respond in kind.
Brian, you also refute the fact that he suggests these issues have gone back as far as the 90s. Is that right?
Well, there was one comment that he makes in his report where he said, or he claimed that in the late 1990s, there were questions and that portfolio managers would just index the stock just in case they really thought there were problems. That's a bunch of garbage. St. Jack Welch was still the CEO. Nobody would criticize the company in print because, it was thought that they would, I'm joking, kill your family members or something. No, this stock had a halo around it. Even when Jeff Immelt took over as CEO for probably the first 3, 4, or 5 years. So no, it wasn't until about 2006, 2007 that people in mass really started to question the company.
This is a company that has certainly been through several pretty rough years. It's in the midst of a turnaround right now. That long-term care insurance business is certainly in focus. In your assessment of the company and of the stock, do you expect that it's going to have to take greater reserves for that LTC business?
Right. Well, Mr. Markopolos makes a case for further reserving. I wouldn't discount that possibility at all. I mean, when you think about, the aging of the book, some things he does point out, and the fact that interest rates have remained very low, that's hurt any company that underwrote thinking they were going to earn higher returns than they are. But that won't be GE specific. That will be for any insurer which has written these 30, 40, 50-year liabilities. That's
is that priced
pretty
into
realistic.
The stock? Do you think that possibility is priced into the stock here?
A lot of it is. Exactly how much, we don't know. I mean, that stock was in the low to mid 20s when LTC first blew up in the public market, and look where it is now. And that got the shares down to really about where we are now. So, Keith, if I'd have to say yes.
Keith, what's your take on all of this? And also, how much of this sort of wild card possible risk on GE was already priced in? Because there's been a lot of skeptical analysis of the company for the last couple of years.
Yeah, there really has. And if you watch the slow bleed, as we're talking about here, moving down from 30 into 20, and I made the statement, I may have been on this air here, at $20, I wouldn't touch it when it was really selling off because I thought it was dead money, and that turned out to be somewhat prescient as we come all the way down. But it's really about people not understanding all the various businesses and the components and how they fit together, and knowing that there are problems not only in the LTC business but also in the broader industrial business. And you're seeing that reflected. I mean, listen, I can't tell you that I know a lot of people that actually want to touch the stock even at these levels.
Brian, just to wrap all of this up here, in terms of the accounting, which is certainly under scrutiny on the heels of that report yesterday, we do know that regulators have investigating some of the company's practices around how it's accounted for certain businesses. What is your expectation for that, and how do you think this report fits into that bigger discussion?
Great questions. By the way, I'll take a little bit of issue with some aspects on the industrial portfolio. With respect to the accounting, clearly there was aggressive accounting. It's why we're going now to probably our third CFO in about the last 3 years, right? However, regulators can and do take a holistic approach. And when they come in and they're already there, they're looking at, is this the same management team now? And you have a different CEO than you did a year ago. And this is not a lifer. This is somebody who's come in from the outside. I would flip a quarter with Larry Culp over the phone and trust him, okay? I've known him since 1997. This is a different leader. It's a different situation. You have a new CFO that will be coming in. Regulators will look at that very differently than it's the same group and they've taken another charge. On the industrial side, look, there are challenges. We know power has to be fixed. It's going to take a lot of fixing. You've got bad business they wrote. But having spent some time, traveling globally, there's good underlying demand for power projects. On the aerospace side, clearly with the 737 schedule being adjusted, that's having an impact on the aerospace supply chain, but the underlying fundamentals for aerospace are still fairly sound. And healthcare is healthcare, so I wouldn't say that the industrial portfolio is, broadly speaking, a debacle. However, the huge one that has to be dealt with is power.